Hey everybody, welcome back to Getting Started with Stock Investing. My name is Mike Fairborn, sitting in for Mr. Kevin Horner, who's taking some time off. Hope he's having a great time. Folks, I hope you're doing well. Today I wanted to take a look at, some of the concepts of growth investing, but I wanted to look at, certainly projected growth that could be expected from analysts going forward as a projected earnings expectation, but also building that on historical earnings growth as well, which a lot of institutions and analysts will also look at to try to get a better idea of stronger earnings growth, which could ultimately tie in to a company's stock performance. So wanted to hit growth today, maybe bring in a little bit of value at the end, perhaps. We'll talk about some value investing as well as it ties into it. Growth and value, kind of a combination, but welcome to all of you. Would like to also say, joining the chat by a good friend of mine, great colleague, Connie Hill. Privileged to have Connie on board with us, folks. Any questions or comments you have, she's very well qualified and great to have her on board with us today as we're filling in for Kevin. Hello to you, Chuck. We've got Priya, Kevin, David, I'd Never Eat Here, Jay Richardson. How are you, all of you, as well as Scott, coming to us live from Hawaii, I believe, with the aloha there. How's it going, Will, as well as George? Welcome all. Folks, let's start off with some disclosures to get the show on the road here. Now, information here is for general information purposes only. The paper money software application is provided for educational purposes only. Now, investing does involve risk, including the loss of principal. Past performance is no guarantee of future results. There's no guarantee that an execution of a stop order will be at or near the stop price. Trailing stops and other conditional orders are held on Schwab's servers and not routed until the order conditions have been met. So wanted to hit a few of those as we do get started here. And let me just pull one little thing up and we should be good to go. Perfect. Okay, so setting this up, let's go into our charts here just real briefly to see how we've done. We have been getting a little bit of a pullback in the markets here. A lot of times investors will, after a fairly decent sized move in the market, they might see a pullback. You can see that we did recover a little bit today. The SPX is up right now, 28. One thing that I had mentioned that could be throwing a little bit of an issue, in terms of competitiveness with stocks. I'm just going to pull up TYXCGI right here and just give you a good solid look at what the 30-year Treasury bond has been doing. It's been going higher, just the index itself. And you can see those yields. If you move the decimal just one to the left, it's 5.065. We broke above a yearly high here in terms of yields. And you can see that fairly clearly here. And one thing that I could mention too, and I'll pull up the TNX, which is the 10-year. A quick note on the TNX, which is also breaking a recent high, not an annual, not a yearly high, but a quick note on that. Folks, can you see something very clear here? Perhaps a shoulder, head, and shoulder pattern. We don't know if we're going to get a higher move over here, but normally, when you get a break like this, and perhaps, we're breaking above a trend line right here, and we could see a little extension higher. Maybe we'll test some of these highs up top here. But as I wanted to mention, as Treasury yields increase, the interest rate themselves increase, what can happen is it can be a more competitive environment relative to the market. I don't know if that could influence things, but oftentimes, if you are breaking into that upper 4-5% range, we have seen markets pull back at such levels. Okay, so just park that in the back of your mind. That could be something to keep in mind as you are out there stock investing and looking at stocks themselves. But for example, I should have just noted this real quick. The head shoulder pattern that I mentioned, inverted head and shoulders, that is. As you can see, if you follow price patterns, I do quite a few of those. But if we were just using a neckline break, I'm just going to estimate somewhere through here. Some might draw it a little bit differently. I'm going to use a little bit different range here. But they would basically just say, the shoulder range, maybe from this high to this low, measured off of this line here, could be a price projection to the upside. In other words, we could see a climb in treasuries, and that could put pressure on the S&P 500 group of or basket of companies, or just the market in general, as we like to say out there in the market. It could pressure it. That's why looking at earnings and expectation of earnings could be very, very important. Now, I do look at a couple of different earnings Let me just pull up Meta as an example trade, just as we begin talking about this. First of all, there is past performance of earnings. And many of you, I think, know this is a getting started class, so I do want to take it easy on throwing out a lot of data right at you first from the get-go here. But a quick note, I do have my earnings figures down below. I've also got, earnings. I've got just basically corporate actions. I've got dividends. This company happens to pay dividends. Quick note on dividends too. Dividends can be cut at any time. Since I mentioned dividends, I mean, that's, they don't need to necessarily remain, but yeah, it's interesting. Meta Platforms does pay a dividend. So do a lot of these big tech companies these days, but it is there. Now, to get this on here, it's really nice to have on a chart. I must say it's one of the really great features because I do look at technicals and fundamentals. That's part of the way that I like to invest and trade, because why not? Why not try to improve the probabilities of success or the potential for success? A lot of way traders and investors will look at it by looking at what's going on behind the scenes, lifting up the hood of the car and seeing what's inside the car as opposed to just what the car looks like, is a way to kind of explore investing, right? I mean, we're looking at the fundamentals, the core of what keeps that company running, not just the shell, not just the chart, but what's behind that chart. Okay, so to pull these up real quick, I'm just going to click on my gear up top. As I'm on the charts, I'm going to click on equities right here. I'm just going to make sure that the show corporate actions is on. That's it. All right, now that once that's on there, you can see in the past, if I click on, or if I just point to any of these, you can see it does post earnings. The estimates for 4.7, the actual was $5.16. That's an earnings beat. Now, a few things are going on with earnings that we just need to remember structurally, right? First of all, okay, there was an earnings expectation, there was an earnings beat. Right. So companies can beat expectations. You'll notice that after that expectations beat on Meta, we did see a little bit of a gap in the price of the stock going higher. It's not so much always what you did to beat on the quarter, it's also it's something like this. Not only did we beat this quarter, but our expectations are higher down the road. A lot of stock investing is based upon what is expected, you're expected to get in the future. I've seen companies smash earnings before, but they guide lower, or they say something like, it's very difficult. It's a cloudy future for us. I've heard those words before. Or expectations are a little bit gray into the future, and the stock, even though they did a fantastic job, the guidance was bad and the share price dropped. I'm sure you might have seen that before. So it takes a few things. Like, for example, over here, my guess is, I didn't check this specifically, but with Meta, if I point to it over here under earnings, sometimes you have to click away and then point right to it. 5.07, they smashed earnings, but they probably guided higher as well. Not only did we get the gap, but there was the guidance, and that can help prices going higher. Folks, after that earnings gap, it was a positive, right? So we have some earnings beats where the expectations were the company's going to meet at this level, but they came in at this level. So really, maybe the fundamental value of the company, you could say, what it's actually worth, came in higher than what was expected. And a lot of times, if the estimate is low, it was low down here, that can help to influence prices to the downside. And then it can be a real wake-up call when they guide higher and things are stronger, and prices will continue, prices could go up. So we have that component of earnings that needs to be noted. Okay, that is something that you can consider. I want to actually look at a group of companies here that have had earnings beats for the last 3 quarters. So that's kind of like an earnings beats. It's also called earnings surprise. Now with this though, collectively, so we've talked about surprises would be one, earnings surprises, but the next one would be, what is earnings historical growth? What does that look like? And I've read a number of different from analysts and the way they perceive earnings, and you can just tell because a lot of times how they select companies, a lot of them, not all of them, but they might look at a 3 to 5 year. I think 3 years actually really quite common. 3 years of earnings growth or lack of growth, but they're looking back at 3 years. But what I'm getting at here is historical earnings growth. So there's a history of growth previously. So in other words, as we come back here, and I'm just going to go over here, I've got this, let's line this up to a daily weekly chart. I'm going to just go back into Meta as our example and show you. That's a little bit too far out. That's monthly. I'm going to get since we're talking earnings, I'm going to make sure I get those corporate actions even on my weekly chart here. So it goes back to about mid-2023. That's okay. We could just use a little bit of this. We'll use this much data. So looking at a little bit longer term, as we go back and we say over the past 3 years, using something that analysts will look at. So we're looking at a 3-year time frame here. What has the earnings per share, the EPS, been in terms of a growth rate? How's it been doing over that time frame? What is the growth over a 3-year time frame? A lot of times for growth investors, and this is just exclusively growth. I mean, a lot of times they'll say 15+%. So greater than 15%, I'll also say greater than or equal to, right? 15% growth in earnings. That's like defined by a lot of traders, investors, really, more investors, right? For growth. And that's like defined as a growth stock. If they can do that on average, a 3-year average, I better put average in there because that's exactly what we're referring to here, of earnings, that would be considered growth. But what are we doing? This is all about history, the history of earnings. That's all history. So they want to get a record that the company has in the books been able to meet this earnings growth on average 15% a year. Now, we don't always have to shoot for 15. And a lot of times traders will say, gosh, at least give me, 5 to 10. 5 to 10 at least. This is just exclusively growth. But that's not too bad. I mean, there are some companies that have grown, 40%, 50% on average over the last 3 years. And that's something really quite interesting. But so we've talked about surprises, right? Earnings surprises on any one given earnings announcement, on a quarterly announcement. Then we've talked about a longer time frame, like a 3-year time frame of growth in the past. That's a little bit separate. The next one is, what about the earnings expectations coming up? So we're looking really over into this time frame here. What about over the next 1 year? Now keep in mind, this is not a guaranteed number, but on these conference calls, these executives, what they'll end up doing is they'll talk about, hey, this is our expectation for growth going forward. We kind of mentioned that with the earnings surprises, right? We said, this is the growth going forward on a company. Well, the analysts will talk to the executives and they get a lot of different information. And we're dealing with companies that are, fairly well known. A lot of times I look at, maybe companies in the S&P 500. They might have a fair number of analysts. And these analysts get sometimes a better sense. And it's safe to say in a lot of cases that the companies that have been around for a little bit longer, the ones you might have heard from, maybe some of those on the S&P 500 relative to, let's say, penny stocks, their executives might be a little bit more experienced on the S&P 500. Safe to say CEOs on the S&P 500 versus penny stocks might have a better idea sometimes as to where their company's projected to grow into the future. They're not always right, but they might understand business pretty well. And sometimes that attracts a lot of analysts because they have expectations for the projected. I've got to put this in here because it's a projected number. It's not a guaranteed number. It is all, folks, projected into the future. But wouldn't it be interesting on the Schwab platform to take a company that's got a 3 to 5 year average earnings growth of, let's just say 15%. So we're really identifying growth here. And then say they're also projected to grow at greater than 15%. That's what the collective number of analysts estimate, right? At 15, I'm just putting 15 plus, but it's actually 15% plus, growing at 15%. So you're doing a couple of things here. We've got a record, we've got a history. Hey, these guys have been able to do it in the past. So they're also guiding that level greater than or equal to 15% in the future too. And it's on a company that's maybe are part of the S&P 500, maybe a company that's had a history of growth. A lot of these small cap stocks haven't had growth. I mean, they've actually never had. Okay, I take that back. They might have had growth. A lot of them haven't. Okay, they haven't grown earnings, and many of them have been losing ground year over year over year over year. They've just been losing money, but they've been collecting money by selling more shares to the market or whatever the case is to keep the company afloat. They may have been growing revenues, but not earnings. And it's earnings that kind of over time gives us that value of the business, maybe the intrinsic value, the way a lot of traders, investors describe it as. It's intrinsic what the company's worth. So it doesn't perfectly correlate to these earnings announcements, but over time, notice down here, let's just, as an example, we're looking at earnings. So what do we have over here? That's $1.76. Now look at the price of the stock. It's about 100 right down through, 100 to 150 range. What do you see over time? 2, 4, 5, 4, 5, 6, 8, 6. It's okay. There might be ups and downs. We did see a pullback here. They did beat earnings, and maybe the expectation is higher as well, but it did dip on that. But you notice down here what earnings have been doing? Folks, earnings per share, because we're dealing with publicly traded companies, that's why we add the per share in there, earnings per share. It's been going up. What do you think would have happened? Honestly, if we would have looked at these numbers, and you guys need to be honest with me here. I don't want any smart remarks. I'm kidding. No, but if you go over here, if it was 176, and instead of 176, what if we were to drop all the way down here? And right now it's at 2 cents. Do you think that over this time frame, which really represents a little bit over 2 years from here to here, do you think the stock would have gone in that direction? That's the value that earnings at. I've got to check the chat just to see if somebody said, yes, I do. No, they didn't. Okay, good. Not yet. I'm going to keep an eye out for it. But that's the whole concept of earnings, folks. That's the idea, is that growth in here going forward ultimately has a connection to the stock. Now, as Warren Buffett has said, in the short run, let's see, maybe it may have been Benjamin Graham, his mentor, right, that he learned a lot from. But he said in the short run, the stock market is like a voting machine. I mean, if you see it, like the volatility, I mean, you don't take my word for it. Just look at a 1-minute chart sometime. That's volatility. That's a voting machine, right? And that's his explanation of it. But in the long run, it's a weighing machine. Short run voting machine, long run weighing machine. Now, the first time I heard that, I'm like, okay, I think I get it, but I wasn't quite there. What is it weighing? Well, one thing it could be weighing, this is the third time I've drawn this in, earnings per share. It's weighing the earnings. And specifically, over time, those historical earnings. One thing that Buffett has talked about a lot, you'll find it right on the balance sheet too, is that retained earnings. It's earnings that the company is keeping. So what is happening to the value of that business? I mean, if they have more money and they're growing and they have more potential to invest, capital investments, well, they have more potential to, in fact, grow into the future too, right? I mean, there's more potential to grow, and they might have more money. I mean, I don't know, sitting on the sidelines too, invested in other investments that can also yield returns too. So it's a weighing machine over a period of time, and we can see that clearly. There are other aspects too, like say, for example, if a company issues like tons and tons and tons of shares, they might have earnings, but on a per share basis, it doesn't really benefit the shareholder, does it? If they keep issuing more shares, they might be in, perhaps some companies, I've seen this before, they issue a lot of shares, and suddenly the executives of the company, oh, what do you know? Their salaries start to increase, their bonuses. Where are they getting that money from? Well, they're issuing more shares, but they're reporting lower earnings. And so, per share, that is, they might have total earnings higher, But when they divvy it out to shareholders, they say, forget it. I'm not getting any value out of this. You guys are taking everything we've got and, building on it for yourselves. So companies are smart. I mean, a lot of executives are smart. They don't do that. They don't issue excess shares. In fact, they try to buy back shares. You've heard of that. In fact, I think it was AMD. Was it 5 billion shares? No, I'm sorry. It couldn't be 5 billion. $5 million in $5 billion in shares. A little bit of a flag pattern there on AMD coming over, but these are just kind of different considerations to look at. Now, today, what I want to do is I want to build a earnings historical growth and projected growth at the same time on the Schwab platform, all under the S&P 500. But before I even get there, I've got a little addition that I wanted to add to you guys, show to you guys that on the S&P 500, I want to look at some companies here that have had a few quarters of earnings beats as well, like three at least, 3/4 of earnings beats. Let's start off with a few of these here, and we'll just see how this might have influenced. We saw how it influenced Meta to the upside, but these have had at least 3/4 of earnings beats here. And you might see how there may have been a change of trend that occurred going back 1, 2, 3, because we are past this point. But what happened with Deere? Just watching earnings only, earnings alone. Well, what happened over here? So we were kind of in a sideways channel, at least is what we can see over here. And then, actually, I think there might have been 4 beats off the bottom. In other words, I think what was happening, we were going down and we beat. I'm going to check that here just a second because I am curious myself. Did we get an earnings beat down here? Let's take a look. So one thing let's do is we'll just point to it. Well, I know we got it here because I took a look at these. So there you go. It was 389 to 455. Another one. 313 to 319. There's another beat. And last but not least, on the gap up, 568 to, sorry, I missed that. 568 to 664. Pretty good beats. And what's interesting, by the way, here's that fourth one, all the way back here. 579, 629. Earnings themselves can tell you a lot. We're not even looking at the stock trend. We didn't talk about anything with technicals at all. We just said the company's beating earnings. The estimates in the market are going higher, and there's a track record of it. And as they're going higher, the company's actually also getting historical earnings coming into the mix as well, right? They have historical growth because you could see these are going up over a period of time, all the way up to 6. What did we start off with over here? 4 something? I can't even say. 5, 4. Anyways, it's 646 up top here. 664, sorry. 664. Okay? And that's just saying, hey, sometimes when they start growing and projecting out, they can fulfill, and sometimes traders might trade the chart along here too. Let's get some more in here for you. There is some that have been beating earnings. Now, they're not always going to be perfect because sometimes the expectations are really, really low. That's not the case here. The expectations continue to increase, and the company continued to beat those expectations. Netflix, we're going back at least just 3 quarters here, and this is pretty clear. What did we see chart-wise? Sideways, folks. Sideways pattern. Oh, there's the gap. What could that mean? Probably 2 things. They probably beat expectations and guided higher. Let's point to it right there. There you go. I'm just going to go through these quickly. About 509 to 540. 418 to 427. Finally, we're getting up even higher to 6. 568 to 661. Big beat there. Okay, think collectively. Think a weighing machine over time. Think earnings and retained earnings for the company. Is the value going up? Folks, if collectively, if all of us had, everybody here in our room right now, we all owned a company, and this company was doing really, really well, and our bank account kept going higher and higher, do you think the value of our company would be worth more, especially with growth and exceeding expectations of growth? Would it be worth more? Short answer is probably would be, right? There could be other considerations, but it could be a big influencer. That is what you're seeing on the charts, is what that phrase refers to as. It's if it's worth more over time, it weighs that value, and prices can often reflect that. We talked about some of the variations there. They could unfold, right? There can be some variations in terms of issuance of shares, but these companies don't want to kill their share price either. A lot of these companies, in fact, the executives of the companies do get stock options based upon the performance of the underlying stock. Let's take a look at DEC. Now, DEC has dipped, and I don't know exactly what happened over here with DEC, but it might have guided lower over here, even though, so this is a good variation to look at. It did beat at earnings, but guess what there was? There was some guidance going forward, clearly. Came in at $2.60. Hang on just one second, folks. I've got to mute this thing. All right, and $2.60, and it missed. They probably guided lower. Now, you see what happened? We didn't even get earnings here yet. It's going to come up. It's aftermarket today. So in about a half an hour, we'll find out. But it did beat here. It did beat here. It did beat here, but it guided lower here. Now, Deckers is a little bit different from maybe a couple of those initial companies that we looked at. There might be a cyclicality to something like Deckers too, and those are always a little bit more challenging. I mean, there's that component of consumer discretionary. If things are tough in the market, well, what are you going to get? What do these guys have? Let's take a look at it. Is this discretionary? Footwear, apparel, accessories for casual lifestyles. That's Deckers. They also, yeah, so that's what you're looking at. That's all discretionary. Discretionary has cycles like this. Expectations of the markets. I think tariffs were probably a big thing there. But I want to throw that in there because not every company, sometimes you don't look at those that have maybe, they might have like really, cycles that are really, really tied to the economy can be tricky. And I'm saying like commodities too can be as well. All right. So on that, there are a few just to look at. What we want to do too, though, let's do out one more. There's actually D in here, which is Dominion Energy. And I'm going to make a point on Dominion as we go through here and look at the last three. So there you go. It beat, these aren't huge beats, but it beat nonetheless by 4 cents, 6 cents, and about, let's see, 7 cents we beat. So these are small beats, but sometimes too, I'm just going to park this in the back of your mind too. If a company's beating earnings, sometimes they have more capital, more cash to also be able to afford the dividend. This guy does have a dividend in here, and maybe it affords them the ability to at least keep that dividend yield going and possibly increase the dividend down the road. So there's another benefit there. If earnings are growing, and particularly they're beating earnings expectations, because I mentioned dividends already, let's just pull it up right now and see what the dividend yield is on that. So it's very close to just under 5% right now at that level. So, even with earnings, tying it into income could be sort of an income sort of earnings and value possibly play, because look what prices have done. Prices have stayed relatively flat, and you're still getting a price that's basically, very close to where it's been, towards the beginning of, 1 year ago, let's say. So the dividend yield could be higher as well, with maybe expectations that ultimately it could go higher. So there's a lot of different ways to interpret this, but I just want to throw a couple of these out there for you. One's income, one was cyclical, and the other two were really not cyclical, just growing, and prices were reflecting that. Okay, well, let's do this. I want to move on now into earnings history. So we can do that Schwab scan to look at historical earnings and projected earnings as well. So let's get that started. I'm going to go up top here. I'm going to go into research. Let me just take a quick look at the chat as well. But here are my research tools right here. Let's go into that. We're going to see our scan pop up. So I just started off with schwab.com, just so everybody's on board. But there is the stock screener when that comes up. Okay, give me just a second. Just want to pull up chats and make sure we're good with everything. Oh, yeah. So George says, exactly. Changing the float versus buybacks will juice EPS. Right. So if you're buying back more of what's available out there, that's a great point, George. I mean, if there's less shares out there, then those are earnings. People that have, here's a great example. Let's see, I think it's Booking now, BKNG. Okay, so look at the price of Booking. Okay, we're gonna do a little bit of a deeper dive here on this, just to highlight this point, because we're gonna extend it a little bit more based on George's question in terms of float. They buy back shares, reduce the number of shares outstanding. But what does that do to the share price? Some companies are just dead set on not issuing any shares at all, or trying to buy back a number of shares, so that the earnings that the company has are just spread across fewer and fewer shares. And that can also be a real benefit for the shareholders of the company, right? The value that they're getting independently, individually, is more because they've reduced the number of shares. So it's spread across fewer shares. Let's go ahead and point this out right now. I don't know if we could do this just for the heck of it. I'm going to go over here and look under BKNG. I don't think we have shares outstanding here on Thinkorswim. That's okay. What we'll do is we'll go over here and we'll go right into Schwab. I'm just going to duplicate this and take us back into BKNG. And I'm going to show you exactly what they've done. This is a great place to really examine what they've done with their shares as well. So let me just scroll down a little bit. Let's go into, not earnings, but we got to keep going down into the statements. Now, to get the full list of statements, we've got to go under Show More right here. So click on that. Expanded statements. I do want to look at the balance sheet. So let's look at, and I wanted to do an annual's good. This gives us the 5 years. And by the way, it's a little bit funny, but this goes from right to left. This is the oldest. Thinkorswim is just the opposite, right? It goes from left to right. This is right to left, 2020 to 2024. So what I want to do now is I want to scroll down, and we're going to get to shares outstanding, which is going to be under our shareholder equity section. Total common shares outstanding. What do you guys see here? You're seeing that right. These are in millions. That's 41 million shares. Do you know how many shares that other companies have out there? I mean, I'll do a comparison. Let's just say with the Texas Instruments or an IBM. It's insane, the number of shares relative to this. What have they been doing over time? They're still cutting this back down. 41 million shares to 34 million. Okay. They're cutting short. You're making, I mean, look at these numbers. That right there, they made almost $84 a share. Now that did go down, but they bought back shares as well. And what's that doing to the share price? So right there, George, that is a visual for you of what we were talking about, and everybody else, right? How's it going, Mike? Great to have you here, as well as Wiley, others just joining us. But that's a key point. I was just talking to JB the other day too. We were just talking about, hey, you know what? We were hitting this concept a little bit, but during the gold rush of 1849 in California, a single egg, they were selling a single egg for $3. And that's when a dollar was a dollar. Equivalently, that's $1,500 for one egg. Demand was high and supply was very low. Similar things can happen with shares. If you have fewer shares and more buyers, maybe price is a little bit more sensitive to the upside because there's just fewer shares out there, tying in to George's point about the float. All right. So that was an extreme example. I was going to show you this too, though, just so you can see, like, that 33 or 34 shares is a low, 30 million shares is a low number. Let's just do something like this. Yeah, let's do an IBM. Pull it down here at the bottom, and we'll just see where we stand here. So that is 915 million shares. And Intel has how many shares? They might have done some buybacks. No, that is 4.228 million shares. So that 4 billion. What was Bookings? 34 million shares. What's the price of Bookings? $5,300. So maybe one of the best examples out there. There are a few companies like this out there that have been able to retain that. And by the way, this is really fun too. 15 years. There you go. They were all the way down here. Did it have an impact on price? There's your low, 173. up to 5,053.79. There you go. Okay, cool. All right, well, let's do this. Let's dive on into this because I want to build this search too. You guys, I'd love to go through all your questions. You guys have some great comments and questions. I'm sorry I just pick on a few when I see them, but love those when they do come in. And thank you, Connie, for your help as well. But just a quick visual there. Okay, we're going to start this from scratch. We're going to build this, but we're going to build it, remember, history versus projected earnings growth. And what I want to do right now is I want to go specifically into, let's go into financial strength. But actually, before I do that, we're going to go into basic. And I'm going to select exchange. This is the easiest way. No, I'm sorry, not exchange. Let's do index. That's what I wanted. Index, S&P 500, so we can select exactly what we want to take a look at here within these companies. So we've got the S&P 503 is what it is right now. And with that, I'm going to scoot on down next and go into financial company performance. Sorry, company performance. Here we go. We're looking at the history of earnings growth, and we've got the last 3 years, we got the last 5. When I saw this, I'm like, okay, somebody at Schwab must have known what I've been reading, or I mean, they must have read it or been very well aware of it. But this is where analysts will often look for a history of growth. And it's funny because they provide 2 of these. Now, for growth stocks, normally they want to see what's been happening over a shorter period of time. So we're going to go ahead and select the last 3 years. Remember what our number was for growth? We're going to do a tight search, what's referred to as a tight search first, and that is everything enter specific value greater than or equal to 15. Tab through. There we go. Greater than or equal to 15% on average the last 3 years. So that's our history component. In other words, the company has shown the ability to grow in good times and in bad times over that last 3 years, right? I mean, 3 years was rocky. 2022 was a tough year for a lot of businesses, right? The environment was tough. We had that inflation that was persistent. It wasn't intermittent and caused a lot of issues. These companies grew through that. That's in the S&P 500. On average, they did. Now, what we want to do next is we want to tie in, connect to that. They've been growing in the past, we know. So over here in the past, we've got that 15%, but we want to try to confirm that they're going to grow over here into the future, projected. We're confirming a projection. So it's not confirming the actual number. We're just saying as it stands right now, because these projections can change, that it's going to grow at 15% or more. Okay, so what we want to do here is we want to scoot on down, and there it is. Instead of saying projected, we have another term there. It is called estimated, meaning the exact same thing. Now, when you're looking at the next quarter is such a short-term time frame that a lot can happen. We don't know why the expectations might be higher in one quarter. Maybe they're selling off a division or something to generate and really beef up and bump up those earnings numbers for a quarter. What we want to see is the whole entire year, the current year. That's what we're after. Now, sometimes traders will go longer term. Now, you have to be careful with growth stocks on this because a lot of times the executives would never, folks, and I mean, they've been asked by analysts for a 3 to 5 year. They're doing everything they can to get a 1 year. So this is like on companies that like maybe the consumer staples. I'm just going to throw out some names. Pepsi, Coke, Clorox, things like this, Procter & Gamble, where those executives will go out that far because they can. There's an expectation there, right? But if we're talking like growth stocks, a lot of changes right now. We've got tariffs into the mix as well. So what we're going to do for growth, because that was our topic today, we're going to stick with current year. Just wanted to give you some thinking that's going, that's behind the scenes as to why we would choose 1 year as opposed to a next quarter or even out much longer, 3 to 5 years. Okay, so we've got that down. Remember what we're going to do over here. We're going to select a specific value, folks. It's going to be greater than or equal to 15. Like we said, a rather tight search. 48. So we're getting a rather reduced number of companies after we say, give me the history of that kind of growth. and an expected growth going forward. Let's see, 48 over 503. Yeah, less than 10% of the companies meet that category right now. This would be a fun one to look at in the NASDAQ as well. But we're going to go ahead and view these matches right here. Okay, AMD's in the mix. We got AbbVie in the mix. We've got, there was our Dominion. Remember that beat expectations already. And you can look at, by the way, with these, you can go back and look historically to see, did they beat earnings expectations? You guys are going to recognize these, Alphabet or Google right there. Let's see, International Paper. You've got Southwest Airlines. You got Merck, Micron, and others in here, Qualcomm. We can put a column in here that shows what subsector they're in as well. But it's really, really nice to be able to have this list. We don't have projected earnings. We don't have historical earnings on Thinkorswim for us to look at or projected. So what we could do too, just as a final note, because I want to make sure you guys can look at these stocks and put them in a scan on Thinkorswim. Just export to CSV file right here. Beautiful. Right there, upper right-hand corner. Boom. It's going to open up there's my results. There are my results right there coming up. Okay, it's popping up my separate window. Pull it up right now just so you guys can see it. Shot straight to Excel. It's got the columns in there. All I really want right now are the symbols, because we can go back and look at these later, but they hit two important fundamental criteria to net as 48 companies. So now that we have some earnings behind the scenes, let's go over here and look at some of these others. Okay. Let's go over here and look at the earnings. Excuse me, I should say the, not the earnings, but the charts themselves. So what we can do is go over here, and all I'm going to do is drop this down, and I'm just simply going to say watch list. Folks, I'm going to drop in here, and I'm just going to say, hey, let's create a new watch list. Let's put these titles in here. Let's just say EPS growth. I don't know. Something easy. I like to date these. So now we have an interesting list of companies to check out that also might have that earnings driver behind them. Now, because we copied those columns, all we need to do now is simply import them and paste them, because they're in the memory, right? The computer. There they are, that fast. Perfect. You've got them all there, and you can go through and take a look at these. I'm going to take a look at Google here too. Let's just pull it up. Yeah. Okay. Anyways, folks, does that help? So companies that now, when you look at Google, growing 15+%, you have a spreadsheet to look at, and then also projected as well. We did get past earnings too. It seemed to gap over those earnings, and possibly, I'm just going to choose this pick on this guy for a second, but it looks to me a little bit like a rounded bottom with the possibility, since we just broke this high, of a cup and handle. Question mark. We don't know for sure, but are we building on earnings behind the scenes, folks? That was the topic of our discussion today, folks. If you liked this session, you found value out of it, smash that like button. Love to have you subscribe, folks, to our presentations here. I do teach a class where I do tie in fundamentals. We don't talk a lot about them up front because we're talking about so many of the technicals. But in the swing trade class, as well as some of the other classes that I teach, I do teach a ThinkScript class where we do look at custom columns and different techniques and tools. But just as a side note, because this is a different group, different batch of you guys that generally resonate towards Kevin, which I think is awesome. He's a fantastic coach. And by the way, Connie's got fantastic stuff as well. But just as a quick highlight, I'm just going to type in swing. I don't know. It's somewhere in here. No, I can't find it. I got a little thing that blocks me right in the middle, but right there. Okay, so you can click on this. I'm just going to throw this link out here if you want to take a look at these. But yeah, we go through and we talk about companies over a swing trade time frame. So we'll look at that short-term technical a lot of times with a good earnings base behind the scenes. Let's put it this way. We don't look at companies necessarily that have negative earnings overall. Be sure and check out Connie's great stuff as well, folks. But here is that playlist. If you would like to check any of those out, you'll have it at your fingertips. All right, everybody. Well, great to be with you all. Thanks again, Connie. Great to see you all, folks. And we'll see you on the next one. Take care, all.